Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, Tuesday starts off with the S&P down about 15 points or so as some profit taking hit the market early, as there seems to be a little bit of question as far as how much accommodation will come out of the ECB over the coming months. So there's some sellers showing up to start the day, but by and large, the market's had a good run over the last couple of weeks, up in neighborhoods of, I don't know, about 4% or so. And this week, we're going to take a look at whether or not the S&P's breakout from the August range is meaningful or not. So we'll talk about that. And then this week, I thought about what part of the market to look at, and I thought to myself, well, where do we put the most money ourselves? And it usually goes into our cars and our homes. Those are the biggest investments we generally have. Right, so I thought today we'd take a look at the car stocks and home builders and just some of the stocks related to them. So there's about a dozen names here that we'll take a look at and see what they're showing us, especially with a headline today on Ford, which got a downgrade of its credit from Moody's. So we'll take a look at each of those charts. Let's also, I wanted to mention that on September 27th, I will be speaking at the MoneyShow in Philadelphia. They're doing a special track for financial advisors, and I'm part of that track, and we're going to talk about incorporating behavioral finance into your wealth management practice. So if you're in the Philly area and can get to that, you will find what I speak about rather helpful. As the game constantly changes on the wealth management side, and the old-time techniques are not as useful as they used to be, especially on the sales side. We're going to talk about behavioral finance and what you can do as an FA to incorporate this into your practice. So again, that's at the Money Show. It runs from September 26th through 28th. I will be speaking on Friday the 27th at 1:40 in the afternoon. So I wanted to mention that. And let's take a look at, again, as we do each week, compare sector movement in the S&P week over week. And what I normally do is just highlight those that have moved over 1% relative to what they had done the week before. So on the right-hand side is through yesterday's close, so year-to-date through yesterday's close, and this is the outperformance or underperformance of each of the 11 sectors to the S&P itself. And on the left-hand side is the same chart just from 2 weeks ago. The scaling is not the same, so the fact that just taking a look at the far right-hand side, the real estate, notice that in this week's, it looks taller than last week, but in fact, there's been a change in the opposite direction. So taking a look at what's moved over 1% or so in the prior or in the past week, consumer discretionary is now plus 5.8% or so. It is up from 4.10, so that had a heck of a good week of outperformance relative to the S&P. Communications are up 3.5% as of yesterday's close versus the S&P. That's up from 2.3, so that picked up over 1% also. Materials got knocked in the last week. They're down 5.4. They had been down 3.8, so they got hurt more. Energy actually had a terrific week for a very beaten down sector. They're down 14% on the year versus the S&P. So, of course, the worst sector there is, but they were down almost 17% a week ago. So that's improved nicely. And healthcare is down 11.7. It had been 9.4, so it lost over 2% in the past week. Utilities are up only 3.4%. They had been up 5.6, so they got knocked for over 2% in the past week. And financials are now only down 1.5 versus the S&P. They had been down 3.4%, so they picked up 2% in the last week. So you're starting to see a rotation from some of the things that had done poorly this year, like financials and energy, and they're picking up a bit. And what's coming out is some of the sectors that had done decently well that are now seeing less good performance. So a potential rotation here, and that's not surprising given that the market had kind of moved up over the last several weeks, and people's fears of recession are a little bit allayed, as well as the fact that the August back and forth price action in the S&P ultimately resolved itself to the upside. Just want to push this in here at this point rather than at the end, because we tend to get caught on time, is just to contact me, Rick at InTheKnowTrader.com. Our website is www.intheknowtrader.com. Lots of videos there, any information on how you can sign up to our weekly newsletter. So now let's take a look at some charts. We always start off with the S&P. So notice here the month of August, and here, let's see if we can get a little rectangle going. So, you know, the trading range of August was highlighted here in this rectangle, and obviously in the last week, we've broken out to the upside. Notice the multiple drives down 3 times. You know, we drove down to anywhere from about 28.20 to 28.40 on the downside. One of the things of importance that I like to look at when I look at charts is that the low of the move was actually the first move down. So we got to 28.22 on August 5th, and all subsequent moves never quite got there, 28.25 and a half, and then this low was at 28.35. So the first move was the lowest one, and that's important to me too, because each time we tested, we still couldn't get beneath that one. And of course, as we break out to the upside, you had the gap last week from September 3rd to September 5th. We've been trading somewhat steady. Obviously, today's, you know, we're under a little pressure. Tomorrow would need to close above 29.76 in the cash S&P to post a setup 9 count, which could be a short-term top for trading purposes. But by and large, I think this move is significant, and that there's still a good chance we'll not only test the highs, but exceed them over the fall. And one of the things that you have to think about is the game of politics. And as November kicks off the presidential election campaign year, the more we get into that time frame, the more I suspect that Trump will want to make things happen that look positive for him, so that he has a higher chance of getting reelected, and that's the normal course of politics. So I suspect the closer we get towards November and past November, the less you're going to see negative statements coming from him as far as China and as far as, you know, there's no deal, I'm not talking to them, President Xi is our enemy, etc. The things that he's done in the past, I think will be, he'll kind of be less vocal about as he wants to win a second term in office. And I suspect he's going to try to do what he can to make a deal happen, as will China, because they're starting to feel some pain from the tariffs and a slowing down economy. I suspect as we go forward over the next several months and into next year, there will be more of a willingness to try to accommodate each other and get some type of deal done. And again, I don't think it's one day, one deal that this is just done. It's going to evolve over time. But the more they can, the two countries can work out differences and start coming together on some of these trade issues, the better the chance that the markets will like it and potentially move higher. We've seen a real turnaround in the last several days. Interest rates have jumped up pretty dramatically. Right now, the 10-year is trading at 167, and it was down about 145 last week. So we've gained over 20 basis points. Gold has given up $50 or so off its highs, and of course stocks have moved up in the last week too. So you're seeing some unwinding of some of the defensiveness that had gotten into the marketplace, and you're getting a little sense of risk on again and people who had gotten too bearish in August, potentially covering shorts on the equity side and helping to fuel some of this rally. So as I mentioned at the beginning of the show, when you think about where your biggest expenditures come from as an adult, it's typically buying a home, buying a car. These are big, type dollar expenditures. And so I figured let's take a look at whether or not both the automobile industry and the home builder industry is actually good, if it's good time to invest in them, being that we spend so much of our money in those areas. So let's make our way through this week's charts. We're going to start with General Motors. And this is, we'll default to weekly charts to start things off. If I need to, we can alter them. So this is a multi-year look going back to 2012 in GM. And of course, you can see the trend lines are actually interesting in how well they've worked on a longer term time period. So if you look at the low in 2012 and connect it to the low in 2015, it caught the low in October of last year. And we got close to it on the Christmas low again. The Christmas low was accompanied by an aggressive sequential downside exhaustion signal. That's that 13 signal. And you'll see there's several of them here very close to the lows. And then, of course, on the mid-year sell-off in June, a week or two before the ultimate low print, we also had downside exhaustion. So this has come back. It's now tested the downtrend line from all-time highs. So these 2 points obviously made the downtrend. So when we tested it, it also happened to be at a propulsion exhaustion level. A better reason to be a seller against it. We've pulled back mid-range, and here we are now. So the chart, when you look, we're kind of mid-range of where we've been for the last couple of years. If this can break above 42 convincingly, then I think GM has a chance to test all-time highs and get up to 47-ish. Actually, that looks like it'd be a minor new all-time high. And it would certainly be problematic at this point, I think, if we break the uptrend line from 2012. So in here, there really isn't all that much to do because it's mid-range. You have no real VIG playing it right here. So I'm not a player of the name now, but I do think these two longer-term trend lines are rather important in the scheme of things, just because of how well they've worked in the past. Let's look at Ford, and this is, well, first of all, let's get rid of these trend lines because this software carries over the trend lines from the prior. So here, let's go take, oops, make it a trend. So all-time highs have a 13. Here's the downtrend line. So on the lows last year and earlier this year, downside exhaustion, called very nicely by these. Market came back. So here, let's take a look. If we go back to 12 or even earlier, I want to see. All right, so these lows were important. So you had a double bottom kind of in here. We broke beneath it, flushed out longs, and came right back. But Ford's got some problems. Again, it's down now near the lows of the week as it got a downgrade by Moody's today. Oops, sorry, today, in fact. And that's putting pressure on the stock. So what's important here is with the last week having been an up close prior to the week before, should this Friday close beneath 885 and change, 8.85 cents, $8.85. If we still see pressure for the balance of the week and we close under 885, gap lower Monday morning, and anytime next week trade beneath this week's low, you get a new propulsion sell signal with a target down here at 716. This is something that institutional traders are going to be watching for. So I'm going to tell you that if you got the name, I'd be cautious if that occurred. It needs to break out above its downtrend line in order to get enough thrust to get towards 12-ish. I do like the fact that it's got these bottoms in here from the sequential signal on the lows of the two lows in the last year of the moves. But with this downgrade now, people are going to be more cautious. And again, be careful if we get and close under 8.85 this week. Let's look at Tesla, which, yes, we do need to put into the car category, even though it does other things. And most important here, notice the 13s on the tops of the move. We've seen it's been choppy enough that there's been no sequential counts on the way down so far. We bottomed against the 2016 lows this year. Same thing over the recent few weeks. We have not broken down properly underneath that's just about 213. That is a key level. To me, it's no surprise that you saw 3 weekly lows here. That's where propulsion signals would kick in on the downside if properly broken through, which they have not yet. Last week's close, same thing like Ford, was higher than the week before, which means should this Friday get and close beneath 212.92, gap lower next Monday morning, and sometime next week trade lower than this week's low, you get a fresh signal, and then you'd be aiming for something like 160. If that doesn't happen, and this week doesn't close above 239, what you'd want to see is an upcoming week that closes lower on the week from the prior week. This week right now is higher. But let's say this Friday we closed under 227.45, then we'd have a down close week over week, which means that if next week we closed above 239.13, gapped higher the following Monday morning, and sometime that week took out the high of next week, then you'd have a fresh buy signal that says 301 and change is the next target. So that's how you play Tesla. Right now, at least it has not broken down properly. It held support where it needed to, right near 213. So there's a minor bullish bias, but not enough to create a signal. If we look at a downtrend line, it looks like it's pretty darn close to where this level is too at 239. So watch for a breakout there. Now notice, a month and a half ago, we broke out above the level, but it was not a qualified break because we broke out here the week after you had an up close. All right, so this week here in July was higher than the week that ended June. That's why even though it broke through that level, it never told us, it didn't convert to, the software will actually convert to little triangles from a dotted line to tell you that the signal kicked in to next target that level. So short term, 239-ish, 240, something right in here is going to be resistance, and pay attention to 213-ish on the downside. Not quite a car company, but I've kind of put it in there because it's got a heck of a lot of fans, is Harley Davidson. And because there's so few car companies in the U.S., I figured let's still get into some people's favorite mode of transportation. I've only been on a motorcycle, I think once in my life, when God, it must be at least 30 years ago. I was in Jamaica on a vacation. And I rented a motorcycle just to tour the island a little bit. So I personally don't get on motorcycles, but lots of people do. Harley's come under a lot of pressure the last couple of years. They've had some issues. There are tariff issues. Notice that the recent low got right to the propulsion exhaustion levels. So when this purple line went from dotted to these little triangles this week, it said we broke properly, that we should get down there, and we certainly got awfully close. Now it needs a proper close above 36.93 to target kind of 43.5 to 45. So this remains under pressure. If we put cloud chart up, you can see it's underneath the cloud. The cloud gets a minor upside breakout above 39.07, but this can't get a buy signal for a while. It would need more time to pass, like another 3 to 6 months of spending time down here than if it broke out above. So like at the, let's say the end of first quarter next year, if you're above 39-ish, then you'd probably have a clear breakout to the upside. Otherwise, for now, At least it's reached some downside target. You can do a little bit of nibbling on the stock, but it's if you like the name longer term and think that this is a potential turnaround story. Let's even look at a monthly. I'm just curious. So here's something of interest too. In 2009, this bottomed into a monthly 13. It had topped on a monthly 13, and now more recently, we also had a 13 signal that pretty much tested. Well, actually, no, it didn't test down to its risk level, but there's a chance here that you do have a bottom in place that's worth nibbling on. So look, you're still in a downtrend even on the monthly chart. You're in pure sell mode, but we might have hit exhaustion. And I like the fact that I see a 13 near the top, 13 by the bottom, and another 13 here that got close to its propulsion level. So for those of you who are fans of Harley Davidson, you might want to be putting a little bit on, but look, the trend is still down, and you don't need to be a hero here. You can wait kind of some time and before actually going after it. APTV active. So this is in the auto parts area and stuff, and this, notice we're getting a 13. Actually, it came in, looks like last month. We're already on an 11 clown. So this is kind of late in its rally. You might extend a little further. Look, if you do equal legs up, and I'll show you something, that a way of measuring moves. I'll take the cloud chart off just to pull it out of the way. So one of the ways that you can project where something goes is take the height of the rally. These are called Fibonacci extensions, and then take it off of the next bottom. And that says at 100%, to match that same move up, targets 95.88. So with the stock trading at 89, yeah, it still may have 5-6% to the upside, but it's potentially late in the rally. It's still going to have resistance in the mid 90s to upper 90s. So it's already had a decent move. It's tough for me to be a buyer at this point, but it does suggest that it still may have some room to go, but realize that you're staring into a 13 signal. The last 13 signal came in just a couple of weeks before the high. The one before that was actually on the high of move for a decent down move. If you're long the name, you may want to use strength to lighten up, in fact. So rather than thinking about this simply in terms of buying it, if you're long, use rally into the mid 90s to lighten exposure. Even back in 2016, the low of the move was an aggressive sequential downside exhaustion signal. And then Borg Warner, BWA. So let's take the extension level off here because it's not relevant for this chart. So this has got long-term support in the high 20s to low 30s, right? Both from the double bottom back here in 2016 and essentially a double bottom over the last year. Kind of like that. Let's see if we're still beneath this trend line from the 2018 January high, and this made its all-time high. Let's see, where is that? That's back in 2014. So let's just take a quick look here where that comes in. All right, so any type pullback here, I think I'd be a buyer in the name. I like the bottoming that we've seen over the last few years in the upper 20s to low 30s. So on weakness, I'd be a buyer. Let's now move over to the housing stocks. DR Horton, ticker DHI. Housing stocks have done pretty darn well. The real estate sector is one of the best sectors this year. In fact, I think it is the best sector. So just even looks like this week we made, this is all-time highs. Hit a propulsion level last week on the highs. That propulsion target never got qualified. I take it back. There it did. So we did hit the propulsion target. This is the type name that you can buy on weakness, just simply because if you look over time, this is a good uptrend, but it tends to be a very step-like rally, right? It rallies and then it pulls back, and it rallies and it pulls back, and it rallies and it pulls back. So typically, instead of buying strength, look to buy a pullback. If you still like the name over time, 120, where's that? About 120.75 or so, somewhere around 120 and 3/4 is one place to consider buying, as is 113 and change. Again, keeping in the basic uptrend and on buying on weakness. Lenore, LEN, not nearly the same chart, not up near all-time highs. This peaked on a 13 and 9 and bottomed on a 13. And has moved up nicely, and we're near a propulsion target. So it failed to break down here, and it still suggests that we're going here, but that's now awfully close. It's only a $1.50 away from where we are. If we can kind of get through this 55-ish level, somewhere around there where you had prior highs, if you can thrust through here. Now look, we're on a 6 count. You may get a false breakout here. In the next few weeks, you may get a 9 count, having broken above this level, and then look for a minor pullback before coming back into it. So don't necessarily buy the breakout above 55. Wait for a pullback, because you may very well get one. See, like this 9 count gave you a flip in the opposite direction. This 9 count here, the market was moving up, but it moved down first before going higher. And you can see how often 9 counts have actually turned the stock. So I suspect it still has room to go on the upside, and then buy the pullback, or even buy some now and then buy some more on the pullback. Pulte, PHM. This one's doing terrific. Essentially tested all-time highs here. Although let's just make sure. No, it's not all-time highs. All-time highs were made almost 15 years ago. But this is also fairly late in the count. I would say you'd want to really see it get above 36.44-ish before, and it needs to do it kind of the right way in order to stop out these 13s. These 13s were terrific. Look for, called for move down, sold all the way down to a weekly 9 count before bottoming. And you can see on the weekly 9 count to the upside, went sideways for several months before continuing the up move. So I like the 9 counts. Here, same type thing. Just generally a buyer and a pullback as compared to right here. I just don't see anything right now. In VR, again, pushing to highs like some of these other ones. This has a 13. The stop of the 13 is up at, well, this is a name that, I don't know. It's a very expensive stock. Let's just skip it instant. We're not going to play $3,000 stocks. Here's Toll Brothers, TOL. This as, again, kind of, I look at this bottoming as a basing pattern. If you get the chance to pay near 33.5 on a pullback, I probably would. I'll assume that would probably be nearer to the bottom of the move, and not be concerned that it's likely going down here. On the upside, if you buy it here, look for it ultimately to get to 43. So that would be a very nice one. And the last one we'll take a look at and finish out this week's show is KB Homes. Stalling against the sequential 13 risk level on a 12 count for the current count. This never got qualified, so even though the upside target's 3170, this whole move never got qualified. Let's just see if I'd be a buyer against the trend line, not until. And that's that. So hope you enjoyed this week's show. S&P is now down 18 or so, trading at 2960. And I'm Rick Bensignor. This has been In the Know Trader. We'll talk to you next week.